Ever wondered if you're getting a good deal when you shop? You probably check price tags, compare options, and make sure you're not overpaying for what you want. But what about your investments? When you buy stocks and build a portfolio, how do you know if you're getting a good deal? How can you tell if you're overpaying for your investments? That's where the portfolio PE ratio comes in. Think of it as a price tag for your entire collection of stocks. Just like a price tag tells you what you're paying for an item, the PE ratio tells you what you're paying for each unit of earnings your investments generate. This video will demystify the portfolio PE ratio and help you understand whether you're overpaying for your investments, how to spot good deals in the stock market, and what your portfolio's price tag really means. Ready to become a smarter investor? The price-to-earnings ratio, or PE ratio, is a fundamental concept that shows how much investors are willing to pay for each unit of a company's earnings. Think of it this way. When you buy a stock, you're essentially buying a piece of the company's future earnings. The PE ratio tells you how expensive that purchase is. The PE ratio is calculated using a simple formula. PE ratio equals market value per share divided by earnings per share. Let's break this down with our example. ABC Company has a stock price of $50 and earnings per share of $5. Now we divide the stock price by the earnings per share. $50 divided by $5 equals 10. This PE ratio of 10 means that investors are paying $10 for every $1 of annual earnings the company generates. We can visualize this on a simple scale. Here we see the relationship between what investors pay and what they get in return. The PE ratio is a key tool for comparing different investment opportunities and understanding how the market values a company's earnings potential. Let's understand PE ratios using a simple pizza shop analogy. Imagine you're looking to buy one of two identical pizza shops. Both shops are identical and make exactly the same profit, 1,000 rupees per day. They have the same customer base, same location quality, and same business model. Now here's where it gets interesting. The asking prices are very different. Shop A is priced at 20,000 rupees, while Shop B costs only 5,000 rupees. Both generate the same daily earnings, but have very different price tags. Let's calculate the PE ratios. For Shop A, 20,000 divided by 1,000 equals a PE of 20. For Shop B, 5,000 divided by 1,000 equals a PE of 5. Now, let's compare these investments to see which offers better value. Shop A requires you to pay 20,000 rupees for 1,000 rupees of daily profit, giving a PE ratio of 20. Shop B only requires 5,000 rupees for the same 1,000 rupees of daily profit, giving a PE ratio of 5. Shop B is clearly the better deal. You're paying much less for the same earnings. This is exactly how PE ratios work in the stock market. The key insight is simple but powerful. A lower PE ratio generally means you're paying less for each rupee of earnings, making it a cheaper investment. Just like Shop B was the better deal, stocks with lower PE ratios often represent better value for money. A portfolio is simply your collection of different investments. When you own multiple stocks, each one has its own PE ratio that tells you how much you're paying for each rupee of earnings from that company. When you group all these individual stocks together, they form your portfolio. But how do we get a single PE ratio that represents your entire collection of investments? The portfolio PE ratio is calculated by taking the average of all the individual PE ratios in your portfolio. This gives you a single number that represents the overall valuation of your investments. This portfolio PE of 18 tells you that on average, you're paying 18 rupees for every 1 rupee of earnings across your entire portfolio. It's a useful metric to understand the overall valuation characteristics of your investments. Understanding your portfolio PE helps you see whether your overall investment strategy leans toward growth stocks with higher PE ratios or value stocks with lower PE ratios. It's like getting a snapshot of your portfolio's investment personality. Portfolio PE ratio uses something called a weighted average. Think of your portfolio like a fruit basket, where different fruits represent different sized investments. The watermelon represents a large investment of 50,000 rupees. The orange is a medium investment of 20,000. The grapes represent small investments of 5,000 rupees each. Each investment also has its own PE ratio. The watermelon stock has a PE of 25, the orange stock has a PE of 15, and the grape stocks have a PE of 10. Now here's the key concept. In a weighted average, the watermelon has much more influence on your portfolio's overall PE ratio than the grapes, simply because you invested more money in it. Imagine a balance scale. The large investment acts like a heavy weight that has much more influence on the balance than the small investment. When calculating the weighted average P by E, the 50,000 rupee investment gets much more weight in the calculation than the 5,000 rupee investment. This is exactly how portfolio PE ratio works. The watermelon investment dominates the portfolio's PE ratio because it represents the majority of your money, just like how a watermelon takes up most of the space in your fruit basket. Now let's walk through the step-by-step process of calculating your portfolio's PE ratio using a practical example. Step 1. Identify all stocks in your portfolio. Here we have 3 stocks: TechCorp, Banklimited, and Retail Co. Step 2. Find the current market price and trailing 12-month earnings per share for each stock. This data is available from financial websites and your broker. Step 3. Calculate the PE ratio for each stock by dividing the market price by the earnings per share. Step 4. Multiply each stock's PE ratio by its weight in the portfolio, then sum the results to get your portfolio PE ratio. This weighted average gives you a single PE ratio that represents your entire portfolio, taking into account how much you've invested in each stock. When we see a high PE ratio, typically above 25, it tells us something important about investor expectations. Let's explore what this means for your portfolio. A high PE ratio signals that investors have strong growth expectations. They believe the company's earnings will increase significantly in the future. Investors look at current earnings and expect them to grow substantially. This growth expectation justifies paying a higher price today for each dollar of current earnings. This creates what we call a premium. Investors are willing to pay more today because they expect higher returns tomorrow. It's like paying extra for a concert ticket because you know the show will be amazing. However, there's an important risk to consider. Sometimes a high PE ratio doesn't reflect realistic growth expectations, but rather overvaluation. When PE ratios become extremely high, it may signal that investors are being overly optimistic. The stock price might be inflated beyond what the company can realistically deliver. Portfolios with high PE ratios are typically associated with growth investing strategies. These portfolios focus on companies expected to grow faster than the overall market, but they come with both opportunities and risks. Low PE ratio typically means you're paying less for each rupee of earnings. On our PE scale, ratios between 5 and 10 are generally considered low. But what does a low PE ratio actually tell us? There are 2 main interpretations we need to consider. The first interpretation is undervaluation. Look at these 2 stocks with identical earnings of 10 rupees. Stock A costs only 50 rupees, while stock B costs 200 rupees. Stock A might be a bargain. You're getting the same earnings for much less money. However, there's a second interpretation we must consider. A low PE ratio might also signal that investors have concerns about the company's future. Investors might be paying less because they expect slow growth, see financial problems, or worry about industry challenges. A low price doesn't always mean a good deal. Despite these risks, portfolios with low PE ratios are often associated with value investing, a strategy focused on finding undervalued opportunities in the market. Value investors use low PE ratios as a starting point to identify potentially undervalued stocks. They look beyond the numbers to find companies with strong fundamentals trading at attractive prices. Remember, a low PE ratio is just the beginning of your analysis. It could signal a great opportunity or a potential problem. The key is to dig deeper and understand why the market is pricing the stock this way. Meet Priya, a tech-savvy investor who believes in the future of technology. She focuses her investments on fast-growing technology companies, even though they come with high price-to-earnings ratios. Priya's portfolio consists of 3 main technology companies. CloudTech has a PE ratio of 35, AI Solutions trades at 42 times earnings, and Mobile Future has a PE of 28. These are all significantly higher than the market average. When we calculate the average PE ratio of Priya's portfolio, we get approximately 35. This is considered a high PE ratio, meaning investors are paying a premium for each dollar of current earnings. Remember our pizza shop analogy? Priya's portfolio is like choosing the expensive pizza shop that costs more but promises amazing future growth and innovation. Why does Priya choose the expensive option? Because she believes these tech companies will grow their earnings rapidly in the future. High PE ratios reflect high growth expectations. Investors like Priya are willing to pay a premium today because they expect these companies to dramatically increase their earnings in the coming years. The high PE ratio reflects this optimism about future growth potential. This investment strategy comes with higher risk, but also higher potential rewards. If these tech companies meet their growth expectations, Priya's high PE investments could generate substantial returns. Meet Rohan, a value investor who believes in buying solid, reliable companies at reasonable prices. He focuses on stable businesses that may not be exciting, but offer consistent returns. Rohan's portfolio consists primarily of banks and utility companies. These are mature, established businesses that provide essential services and tend to have lower price-to-earnings ratios. When we calculate the weighted average PE ratio of Rohan's portfolio, we get approximately 10.5. This is significantly lower than the market average of around 20 to 25. Remember our pizza shop analogy? Rohan's low PE stocks are like the cheaper pizza shop that offers the same quality at a better price. You're paying less for each rupee of earnings. On a PE ratio scale, Rohan's portfolio sits in the low range, indicating he's paying less for each rupee of earnings compared to growth investors who might pay much higher multiples. This low PE approach means Rohan is buying established companies at reasonable prices. While these stocks may not offer explosive growth, they provide steady returns and are less likely to experience dramatic price swings. Portfolio PE ratios reveal two fundamental investment philosophies: growth investing and value investing. Each strategy has distinct characteristics that affect both risk and potential returns. A high portfolio PE ratio typically indicates a growth strategy. Growth investors are willing to pay premium prices for companies they believe will grow rapidly in the future. A low portfolio PE ratio suggests a value strategy. Value investors look for companies that appear undervalued by the market, trading below their intrinsic worth. We can visualize these strategies on a PE spectrum. Value investing typically involves PE ratios between 5 and 15, while growth investing often sees ratios of 25 or higher. The key trade-off is between risk and potential returns. Growth strategies offer higher potential returns, but come with increased volatility and risk. Value strategies provide more stability, but typically generate more modest returns. Understanding your portfolio's PE ratio helps identify whether you're following a growth or value approach, allowing you to align your investment strategy with your risk tolerance and return expectations. When evaluating your portfolio's PE ratio, you need a reference point to understand whether your investments are expensive or cheap compared to the overall market. A benchmark is like a measuring stick that helps you compare your portfolio's performance against the broader market. In India, the most popular benchmark is the Nifty 50 index. The Nifty 50 represents India's top 50 companies by market value. As of May 27, 2025, the Nifty 50 has a PE ratio of 22.38, which serves as our market benchmark. Here's how to compare your portfolio with the Nifty 50. We create a scale showing different PE ratio values, with the Nifty 50's current PE of 22.38 marked in orange. Now let's see how different portfolios compare. A growth-focused portfolio with a PE of 28 sits above the Nifty 50, suggesting higher growth expectations. A value portfolio with a PE of 16 sits below, indicating potentially undervalued stocks. Comparing your portfolio's PE to the Nifty 50 reveals your investment style. A higher PE suggests growth-focused investing with higher expectations, while a lower PE indicates value-focused investing seeking undervalued opportunities. Remember, benchmarking against the Nifty 50 helps you understand whether your portfolio leans towards growth or value investing and how it compares to the broader Indian market. Several key factors influence a company's PE ratio. Understanding these factors helps investors make better decisions about portfolio valuations. Four main factors determine PE ratios: growth expectations, industry type, risk profile, and market conditions. Each plays a crucial role in how investors value companies. Growth expectations have the biggest impact on PE ratios. Companies expected to grow rapidly command higher PE ratios because investors pay more for future earnings potential. Different industries have different typical PE ranges. Technology companies often trade at PE ratios of 25 to 40, while utility companies typically have PE ratios of 12 to 18. Risk profile significantly affects PE ratios. Riskier companies often have lower PE ratios because investors demand higher returns to compensate for the additional risk they're taking. Market conditions and overall economic sentiment also influence PE ratios. During bull markets, PE ratios tend to be higher as optimism drives valuations up. In bear markets, PE ratios typically fall as pessimism takes hold. These four factors work together to determine PE ratios. A high-growth technology company in a bull market will have a much higher PE ratio than a low-growth utility company during uncertain times. Understanding these factors helps investors evaluate whether a PE ratio is reasonable. While the PE ratio is a valuable tool for evaluating portfolios, it's important to remember that it's just one piece of the investment puzzle. Relying solely on PE ratios can lead to incomplete investment decisions. Successful investing requires looking beyond numbers to understand the qualitative aspects of companies. These include company health and financial stability, the quality and track record of management teams, competitive advantages that protect market position, and broader industry trends that could impact future performance. External economic factors also play a crucial role in investment decisions. Market sentiment can drive prices regardless of fundamentals. Interest rate changes affect company borrowing costs and investor preferences, and economic news can create opportunities or risks that PE ratios alone cannot capture. Smart investing requires balancing both quantitative metrics like PE ratios with qualitative factors. Think of it as a scale where both sides need to be considered for a complete investment analysis. The PE ratio gives you the numbers, but qualitative factors provide the context and story behind those numbers. Remember, use the PE ratio as your starting point for analysis, not as your final investment decision. Combine it with thorough research into company fundamentals, industry dynamics, and economic conditions to make well-informed investment choices. Sometimes when analyzing portfolios, you might encounter a negative PE ratio. This occurs when a company has negative earnings, meaning it's losing money rather than making a profit. Here's how it works mathematically. If a company's share price is $50, but its earnings per share is negative $2.50, the PE ratio becomes negative 20. Let's look at Techstart Incorporated as an example. The company has revenue of $100 million, but expenses of $150 million, resulting in a net loss of $50 million. A negative PE ratio is a warning sign that indicates the company is experiencing financial difficulties and losing money. This requires very careful evaluation before making any investment decisions. When you have stocks with negative PE ratios in your portfolio, it creates a mixed situation. While some stocks may be performing well with positive PE ratios, the losing companies require extra attention and careful analysis to understand their future prospects. Remember these key points about negative PE ratios. They indicate a company is losing money and experiencing financial difficulties. Always evaluate such companies carefully and consider their future prospects before making investment decisions. Understanding negative PE ratios helps you make more informed investment decisions and better evaluate the overall health of your portfolio. The PE ratio is one of the most powerful tools in an investor's toolkit. It serves as a benchmark that helps you evaluate whether a stock is worth investing in, much like checking price tags before making a purchase. Think of PE ratios as points on a valuation scale. Low PE ratios often indicate undervalued opportunities, while high PE ratios may suggest overvaluation. The key is knowing where to look on this scale. To use PE ratios effectively in investment analysis, you you need to compare them in two key ways: against peer companies in the same industry and against the stock's own historical PE levels. Here's a practical example. When comparing three companies in the same industry, Company A has a PE of 12, Company B has 18, and Company C has 28. With an industry average of 19, Company A appears undervalued relative to its peers. This lower PE ratio suggests that Company A might be undervalued compared to its peers, potentially representing a good investment opportunity. However, you should also investigate why the PE is lower. Historical analysis is equally important. This stock's PE has ranged from 12 to 25 over the past 7 years. The current PE of 12 is at the lower end of this historical range, suggesting potential undervaluation. The key insight is that a low PE ratio, whether compared to peers or historical levels, may indicate an undervalued stock. However, always combine PE analysis with other fundamental research to make informed investment decisions. When evaluating PE ratios, it's crucial to understand that not all earnings are created equal. Companies can manipulate their earnings, making it essential to assess the quality of those earnings. High-quality earnings show consistent growth, match cash flows, come from sustainable business operations, and feature transparent reporting. These are the earnings you can trust when calculating PE ratios. Poor quality earnings, on the other hand, show erratic fluctuations, rely on one-time gains, use accounting tricks, or hide expenses. These red flags suggest the PE ratio might be misleading. To assess earnings quality, compare earnings to cash flow. They should move together. Look for consistent patterns over time rather than sudden spikes. Always read the footnotes in financial statements and watch for unusual one-time items that might distort the true picture. Remember, a low PE ratio with poor earnings quality may not be the bargain it appears to be. Quality matters more than just the numbers. Always dig deeper to understand what's behind those earnings before making investment decisions. When analyzing PE ratios, investors have two important perspectives to consider: trailing PE and forward PE. Understanding both gives you a more complete picture for making investment decisions. Let's visualize this on a timeline. We have the past 12 months, where we know actual earnings, today's current position, and the next 12 months, where we estimate future earnings. Trailing PE uses actual earnings from the past 12 months. This gives us concrete historical data about how the company has actually performed. It's based on real numbers, not estimates. Forward PE uses estimated earnings for the next 12 months. This reflects market expectations and analyst predictions about future performance. It helps investors understand what the market expects from the company. Here's a practical example. TechCorp stock trades at 100 rupees. Using past earnings of 4 rupees gives us a trailing PE of 25. But analysts expect earnings to grow to 5 rupees, giving a forward PE of 20. The key insight is that the lower forward PE suggests the market expects earnings growth. By using both trailing and forward PE ratios together, investors get a comprehensive view that combines historical performance with future expectations. Financial experts and market analysts have established general guidelines for interpreting PE ratios across different market conditions. The market average PE ratio typically ranges from 20 to 25. This represents what investors generally consider a fair price to pay for each dollar of company earnings. When a PE ratio falls below 15, experts often consider this potentially undervalued. This suggests the stock might be trading at a discount relative to its earnings. Conversely, PE ratios above 25 are generally considered high. This indicates investors are paying a premium, often expecting significant future growth. These expert guidelines provide a framework for evaluation. A PE of 12 would be considered undervalued, 22 falls in the normal range, while 28 would be considered high. Remember, these are general guidelines from market experts. Individual investment decisions should always consider additional factors beyond just the PE ratio. The Nifty 50 index has a rich history of PE ratio movements that helps us understand market valuation patterns over time. Over the past 2 decades, the Nifty 50 PE ratio has moved within a range from 10 to 30. This range represents the spectrum from undervalued to overvalued market conditions. When the Nifty 50 PE ratio drops to around 10, it historically indicates an undervalued market. This often presents buying opportunities for long-term investors. The average PE ratio for the Nifty 50 over the last 20 years has been around 20. This serves as a benchmark for determining whether the market is fairly valued. When the PE ratio reaches around 30, it historically suggests an overvalued market. Investors often exercise caution during these periods, as returns may be lower going forward. This historical range helps investors understand market cycles. The PE ratio moves up and down over time, reflecting changing investor sentiment, economic conditions, and market expectations. Understanding this historical range gives investors a valuable framework for evaluating whether the current market offers good value or if caution is warranted. Your portfolio's PE ratio reveals something fascinating about your investment personality. It tells you whether you're naturally drawn to growth opportunities or value investments. There are two main investment personalities. Growth seekers are like rocket riders. They're willing to pay high PE ratios for companies expected to grow rapidly. They focus on future potential and accept higher risk for potentially higher rewards. Value hunters are like steady train drivers. They prefer lower PE ratios, seeking companies that are undervalued by the market. They focus on current value and prefer more predictable, stable returns with lower risk. Your portfolio's PE ratio acts like a personality test. This scale shows where different PE ratios fall. Lower PE ratios indicate a value-oriented personality, while higher PE ratios suggest a growth-seeking personality. Portfolios with PE ratios below 15 typically fall in the value zone. Steady, conservative, focused on current earnings. Portfolios with PE ratios above 25 are in the growth zone, dynamic, forward-looking, betting on future potential. Imagine your portfolio has a PE ratio of 28. This pointer shows you're clearly in growth territory. You're a rocket rider, seeking high-growth companies with big future potential, even if it means paying premium prices today. Now imagine your portfolio PE is 12. Moving our pointer here shows you're a value hunter. You prefer the steady train approach, seeking undervalued companies with solid current earnings at reasonable prices. Understanding your portfolio's personality through its PE ratio helps you make more informed investment decisions. Whether you're riding the growth rocket or driving the value train, knowing your style helps you stay consistent with your investment goals and risk tolerance. Portfolio PE ratio is like the average price tag of all your investments, but it's not a simple average. It's weighted by how much money you've actually invested in each stock. This weighted average gives you a single number that represents the collective valuation of your entire portfolio. It tells you how much you're paying for each rupee of earnings across all your holdings. More importantly, your portfolio PE ratio reveals your investment personality. A high PE suggests you prefer growth stocks, companies expected to grow rapidly. A low PE indicates a value investing approach, seeking undervalued opportunities. Understanding your portfolio's PE ratio helps you make better investment decisions. You can see if you're paying too much for growth or if you're being too conservative with value stocks. It's also useful for comparing your portfolio against market benchmarks. Remember, portfolio PE is just one tool in your investment toolkit. Use it alongside other metrics and qualitative analysis to build a well-rounded understanding of your investments. The goal is not just to know the numbers, but to understand what they tell you about your investment strategy and risk profile. Thank you so much for watching. If this video helped you understand your investments and portfolio PE ratios a little better, I'd really appreciate your support. Please hit the like button if you found this helpful. Your likes really help the channel grow and reach more people who want to learn about investing. And don't forget to subscribe for more simple finance explainers like this one. Hit the bell icon to get notified whenever I upload new videos about investing and personal finance. I'd love to hear from you in the comments below. Do you think your portfolio has a high PE ratio or a low PE ratio? Share your thoughts and let's discuss what that might mean for your investment strategy. Thanks again for watching, and I'll see you in the next video where we'll explore more investing concepts together. Happy investing!